Hi, you're watching Russell Market Week in Review for the week ending March the 6th, 2015. I'm Mark Soupiset, and we're coming to you today from Russell's world headquarters here in Seattle, Washington. And I'm joined this week by our Chief Investment Strategist, Erik Ristuben. Erik, welcome back. Good to have you again.
Morning, Mark.
Welcome to March. And let's start with pretty darn good non-farm payroll number here in the U.S. Let's begin there. What did you make of the number? What's the economy make of it? What are the markets doing with it?
Yeah, it's a good number, 295,000 jobs. That means the 3-month average, 288,000 jobs a month. The 1-year average, 275,000 jobs a month. In the latest number, 65% of industries are actually adding jobs. Job growth is healthy.
Yeah.
This is a very good period of job creation in a historical sense, and I think that's good because that continues to prove that the U.S. economy is moving forward. Maybe we're getting a little bit of lull in the data in kind of the January-February timeframe. Maybe it's the impact of the West Coast port strike, along with the son of polar vortex.
Right.
But in general news, I think it's really good news that the economy is moving forward. Wage growth wasn't very high. There wasn't a lot of wage pressure in that number, and that's the number we're focused on.
Well, I was going to say, that's one of the things we're following with regards to when we may see interest rate hikes, correct?
Exactly. So there wasn't really a warning sign in this number, but it is an area of intense focus. We're going to be looking for some of the employment cost index coming out later in the month. But in general terms, the U.S. economy is moving forward, and we think that's building a good base for economic growth globally, as well as a good base for risk assets, equities and corporate bonds and high yield bonds going forward.
Okay, good stuff. Let's look at Europe, where finally Monday, they've been talking about it, but it's going to happen. QE begins in Europe, a lot of bond buying. What do you make of that? What should we expect in the days ahead?
Right. So they're going to start buying bonds. The ECB met and they confirmed they're going to do it starting on the 9th, so next week. And that means they're going to actually, instead of just talking about buying bonds, they're going to actually go out and start buying some bonds. There's a big debate on how many people want to sell it to them, and I think what you've been seeing is some interesting things like bond yields on the 2 and the 5, and occasionally the 7-year bund yields have been negative. That's an interesting thing. I'm paying you for the right to lend you money, which is kind of an interesting thing. So it probably what's happening there with those folks is those are not total return investors, right? Those people are buying bunds for something other than total return. Therefore, if you're a return-based investor, you're going to look to another asset class to get you something that's going to be a better return than a negative, say, 20 basis points on a 5-year bund. And that's why we think equities are going to continue to be moving forward and their prices appreciate, as well as the fact that the economy is strengthening. ECB in this week raised their forecast for 2015, the GDP forecast, from 1 to 1.5. And you're seeing retail numbers out of this week out of Europe were actually quite strong. Remember, European consumers have more money in their pocket because of lower energy prices, and frankly, they have really no energy industry to speak of. So low oil prices, good for them in general, and they're actually spending that money. So all good signs that the economy is moving forward in Europe, and we think the stock market will as well.
So let me wrap up with a follow-up to that then. As we see central bankers in Europe ratcheting up QE, we certainly see here in the U.S. central bank thinking about, well, when are we going to actually wind that down? Opportunities for investors there as we see these disparate central banking policies?
Well, yeah, absolutely, and there's also going to be things that you want to keep in mind. One of the big stories of this week again is the dollar. That's nothing new. It's now trading against the euro at under 110. It hasn't traded there in a very long time. And why is, well, we're creating jobs and they're serious about QE. And people are saying that, more likely than not, the dollar is going to appreciate because more likely than not, the interest rates in the United States are going to go up this year. We agree. And that Europe is more likely than not going to continue to try to keep a lot of money in the system. So those are the things to keep an eye on. So, we're really talking to our clients a lot about separating, European equities, which have done extraordinarily well this year, and we think will continue to do well, from the euro, the currency. Think about those as two different exposures and really kind of understand the dynamics that drive both.
All right, good stuff. Erik, as always, appreciate your insights.
You bet.
Thanks for being with me today, and thank you for joining us on Market Week in Review. We'll see you next week.